Good afternoon, everybody. Can you hear me okay in the headsets? Love it. So my name's Felix. I'll be doing double duty here today. I'll be the MC for this afternoon for the investors track, but I'll also be doing the first panel today, which is all about generating alpha in crypto markets. So I have a stacked panel here today of fund managers here to talk about all things alpha, a little bit of beta, but mostly alpha. So we'll go down the panel here, and if you could just introduce yourself and what sort of strategies and what do you focus on in your fund? Starting with you.
Hi, my name is Anatoly. I'm CEO and co-founder of Nickel Digital. We are a London-based, FCA-regulated, multi-strat, multi-manager hedge fund. We've been in business for over 6 years, running market-neutral quant strategies in the space. In terms of underlying strategies, the Stat ARP, RV basis, funding ARP, cross-exchange ARP, HFT market making, mean reversion strategies, and everything is packed as a multi-manager fund. You can think of us as a millennium structure whereby you have multiple trading teams under one fund umbrella. And from the perspective of our investors, what they're getting is diversification across strategies and across individual PMs. Thank you. Prior to that, I was with Goldman here in London, and the whole crypto story came in 2017, which actually triggered this kind of transition from banking into hedge fund world.
Hi, everyone. My name is Nick. I run Fortius. We're a crypto asset manager as well, which we launched a little bit over 3 years ago, backed by Schroders here, the traditional asset manager out of London. We run 3 funds, 2 main set of strategies. One directional long-only token selection fund, whereby we're trying to help investors go and build the right exposure to crypto, to digital assets, which can be a pretty tricky task. And on the other end, we also run a market-neutral fund of funds / SMA platform, a little bit similar to what Anatoly works on, but where we're running certain strategy in-house, certain strategies through SMAs, and also a large number through fund allocations.
Hi, my name is Thomas Bailey, and we run a fund called Road Capital. We have a hedge fund, and then we also have a private fund, venture fund. We're very long term. I sort of think about the liquid side as liquid venture, and then the private side as true venture. The small team, of folks, and we focus mostly on bridging basically traditional finance and crypto.
Hi, everyone. My name is Xiao-Xiao. I'm an operating partner at KKR, leading the digital asset strategy as well as private equity digital value creation. KKR, obviously, many people know, is one of the largest private investment firms in the world with $700 billion assets under management across many strategies, but all like private. So we're not sort of in the liquid side. And then on the digital asset side, we've been making investments from the balance sheet into some of the leading crypto VCs in the world, as well as from our tech growth fund, investing directly into later stage cash flow generating pre-IPO companies, also on the private side of things. Looking forward.
Awesome. Yeah, so as we go down the rabbit hole of unpacking alpha generation in crypto, I do want to start from the top in terms of just level setting on all 4 of your perspectives and definitions of, there's a lot of talk at these crypto conferences and in the industry in general of what I would characterize as beta or levered beta, and not enough talk about some of these alpha strategies. And on top of that as well is, obviously it's quite clear in some TradFi worlds what your benchmark is, but I would say there's still some debate around what is the right effective benchmark to use in some sort of alpha fund, alpha strategies. So we'd just love to hear of all of your perspectives on those 2 level-setting definitions. We will start with you, Anatoly.
Well, when we thought about setting up the fund, our approach was there is, of course, beta, and many people come to crypto specifically for beta, but it comes naturally with vol 50 to 70%. And not everyone is able or willing to underwrite 70% vol. On the other hand, if you can build a solution which runs at single digits vol, right, so in our case, like 5% vol, which is 1/10 of the underlying market, that creates an interesting dynamics. First of all, it fits many portfolios, and B, if you can deliver strong double-digit returns, you're sharp, respectively 2, 3, 4, And that becomes extremely desirable sort of investment solution. So we have gone this rabbit hole, right? And even more so when you have multiple PMs on a platform, each of them can run with vol of 10, 12. But once they're combined, given the uncorrelated nature of these PMs, your fund runs at much lower volatility. And that's what we call alpha in a sense. You can avoid pitfalls of market corrections like this weekend, right, whilst delivering sustainable source of returns, irrespective of market directionality.
I mean, I'll just add something to this, which I think is interesting. When I came to the space, my perspective, and I think the perspective of many people was first, you know, it's all kind of one big trade, right? This uncorrelation doesn't really exist, and all these strategies work at the same time. They all work when retail is there and volumes are high, and basically everybody's making money at the same time and losing money at the same time. And there's a little bit of truth in that, in the fact that in particular high trading volumes, a lot of retail participation help generate, or like kind of a little bit the fuel that help all of these strategies. It's actually remarkable how much uncorrelation you find. And you were talking about this, and if you go across the spectrum of strategies, alpha market neutral strategies in crypto, you can really build books which are very uncorrelated across strategies. I mean, it was extremely visible, obviously, on Friday through the shock. But I mean, we tend to build a range of strategies which, you know, have correlations between 0 and 0.4, 0.5. It's actually extremely low. I think that's one remarkable thing that you wouldn't expect necessarily. Just to build on what you've said, and talking a little bit more from a directional, since we also run a directional product where we're supposed to create value, I guess, by selecting tokens and you know, through some better understanding of the projects, informations on flows in the market, kind of build a smarter portfolio of liquid tokens than just, you know, buying the top 10, for example. I think there comes the question of the benchmark or the index and so on. And there are fairly few in the industry, but you're finding more and more, like S&P has come out and produces reasonable benchmarks. So, you know, essentially when we think of that portfolio, the way we try to define our alpha is kind of maybe put aside Bitcoin and ETH that anybody would own anyway, to some extent, if you would like, to be fair, and then look at all the rest of tokens that you're selecting, and are you actually outperforming a market neutral or equal weighted benchmark of tokens. And I think that's kind of at least one of the ways how we internally try to measure, are we generating value for our investors or not. The tricky part with that is ultimately, I think for many allocators, the benchmark is not an index, the benchmark is Bitcoin. Because many people will think as a space as, well, if I want exposure, I'll get Bitcoin. If I'm going to move to anything else, I better do better. Because if I'm not going to do better than Bitcoin, why bother, right? And so I think that's oftentimes the de facto perceived benchmarks by at least allocators in the space.
Thanks so much for that. For me, it's very, very simple. It's my goal is to beat Bitcoin. You know, I think that's a high bar, but if you consider, since, you know, the history of you know, the beginning of the history of altcoins, you know, it is possible to beat Bitcoin. Over the last couple of years, it's been very difficult, and I think it's all about sort of selecting that right group of tokens to sort of own. You know, and you know, now everybody tends to think that, oh, you should own, you know, Ethereum, Solana, Bitcoin, but in 2022, 2023, people weren't owning Solana in droves, and so making thoughtful decisions around, you know, what things that you want as kind of core allocations, I think is you know, kind of what drives the alpha, you know, above sort of just Bitcoin itself.
Well, I think it's slightly different, right? When you run a huge asset manager like KKR, it's mainly focused on private strategies. And so across the firm, if you think about what alpha generates, obviously the comparison is just the public equity markets, right, and public equity returns. And then to some degree also, like, what are the other main parts of traditional investor and you know, endowment portfolios, right? So it's the other parts within the alt portfolio that an allocator basically could have. And the goal, obviously, for private equity and private credit is to basically beat their public equivalents, right? That's very clear, and it has been consistently demonstrated that the best investors in the private markets can achieve that. Obviously, there's a illiquidity premium that you basically need to beat. And then if you think within sort of a private equity portfolio, both balance sheet as well as in the funds, if you then think about adding some more risk for potentially more return by investing, getting some exposure into digital assets, then obviously on a risk-adjusted basis, you would have to beat the rest of the portfolio, right? And the rest of the portfolio can be invested in just the traditional growth or private equity sectors, and digital assets obviously cannot, you cannot be overexposed to the risk and volatility in the sector, but you do want to sort of add some elements to it to basically enhance returns as well as build more uncorrelated sources of return, right? That's sort of basically how we think about it. I agree with you. Bitcoin, as a personal investor, I would want to have the fund managers I invest in obviously be measured against Bitcoin, because that's sort of the gold standard, and that should be the high bar that asset managers should strive towards, because otherwise, you should just hold Bitcoin, right?
I think on that point, it's a good one to take the perspective of a potential LP who's thinking, all right, well, I'm looking at the fund complex in crypto, and it's tough. It's been tough for many of them to outperform Bitcoin if they're focused on absolute return over the past few years. Whereas, okay, well, if I'm concerned about volatility, to your point, a 50, 70 vol asset, well, it's like, okay, well, maybe what I'll do instead is just fix that through positioning sizing, and perhaps just do like a cash replacement where 5% Bitcoin, 95% cash, something like that, to manage the volatility of the asset class. So my question to you all is, what is the value proposition for alpha in a place where it's very difficult for a lot of people to outperform Bitcoin, and they can just decide on themselves, how do I want to manage that volatility through position sizing? What is the value proposition to pay 2 and 20 for that alpha? Who wants to
beat other asset classes, because there's a perceived unreal additional counterparty risk that you're potentially taking, less and less so, but that you're taking when you're exposed to crypto. But I think that is your benchmark.
Yeah, well said.
But for the fund you and I are running, market neutral, Bitcoin is not the right benchmark, for sure, because you are comparing very different risk profiles, right? So if you run a market neutral fund with 1/5 of vol of underlying Bitcoin, then it's in theory Bitcoin should outperform you 5x to justify the risk you are taking by holding a directional position. And I can argue you should have directional position, as you should have a market neutral as well, right, as an investor. But really, it should be viewed from the prism of risk-adjusted returns rather than absolute number per se.
Mm-hmm. What's the perspective on both of your ends? You both also focus on venture, early stage, private equity. Where does that composition sit within everything we just talked about?
So private equity, unfortunately, doesn't yet exist in the crypto markets, right? Really late stage investment, and the sector is simply too immature, right? I believe it will come in the coming years, but it's not yet a real asset class. Venture, of course, is something that we've looked a lot at. I believe for venture fund, the goal has to ultimately be to beat Bitcoin, because it's essentially a diversified altcoin, investment asset class. Essentially, if you believe that future protocols, future applications in crypto will get massive product market fit and traction, it should be able, at least for the whole period, to outperform Bitcoin, right? It has been very, very difficult, extremely difficult. I don't think any funds in the last 2-3 years have managed, but I think it has to be the aspiration. I think other funds, in sort of private funds, maybe they just pick Ethereum or some others as the benchmark, which is fine as well, or like a basket of altcoins. But I think the venture model has been challenged a lot in the last few years, but I don't think it's as an underlying asset class, but it's more the fact that over the last 5 years, most of the AUM that have come into professional asset management in crypto have gone into venture. and not enough has gone actually into professional liquid and especially market neutral. Sort of in traditional markets, you have like a 80-20, sort of 80% in hedge funds and 20% actually in illiquid sort of venture funds. In crypto, it's the other way around. And I think we're just starting to basically reverse that trend. It should actually, we actually, as an industry, we need professional liquid investors. We need much more, because those are the people that have professional price discovery and that can really underwrite the value of the token beyond just speculation, right? And I don't think enough of that is actually happening. And the other factor is actually late-stage investors as well. If there's no late-stage private investments, you know, protocols and founders just want to like list tokens as quickly as possible, right? And sort of join that sort of speculative fervor at the beginning. I think the more liquid funds and late-stage investment as an asset class, you know, grows in the industry, the better it will actually be for the sustainability of the industry.
I think partially why VC has been a preferred route for many allocators is you are shielding yourself from the underlying vol. Although the portfolio is extremely volatile, right? Not least than Bitcoin itself. Yeah. But fundamentally, you're not seeing this on a quarterly basis.
It's not market market.
Kind of, sorry?
It's not market
market. Right? Kind of, and that is a kind of a very artificial way to kind of isolate yourself from the underlying vol, although you carry this risk anyway. But yes, that was the preferred route.
I definitely think that is true, and there's probably been more allocation to venture than it has been liquid strategies, and so I think that there's definitely opportunity for skilled people on the liquid side. One thing I will say is, even over the last, let's say, 4 or 5 years, maybe it's been hard to outperform Bitcoin. I said that Bitcoin is sort of my benchmark, right? I think we need to let some of these venture portfolios ripen a little bit, right? Like typically you have a 10-year kind of fund, right, life, and I think maybe in the 2-3 years maybe you don't have as much vol, but I think like in the outer years is probably where you might see the outperformance, of some of these venture funds.
Mm-hmm. I think as private investor, also the other thing is like probably market neutral fund, you're much more just focused on returns, and you're sort of you more have like a trader mentality, right? As long-term investor, we actually, when we look at the space, we look at markets and market segments and sustainability of markets. Can we actually underwrite the growth of markets and then the market structure that we believe in there? Who are the best teams and the platforms that have the best chances to take market share and develop market leadership within a growing market, right? That's literally our job, to kind of underwrite a market over a multi-year horizon. And if I think about the crypto markets today, what are the sectors that really have product market fit already at scale? That is what we sort of look, and where can we sort of find future alpha, right? From a sort of growth investing, private equity investing mindset. Really, I think there's like 4 areas where we already seeing real product market fit. Everything else is probably, I think, venture narrative. That's like some of that would have to, still hit. We're not sure yet whether that's going to work. And I think the 4 areas really are everything around debasement of fiat, hedging against that. So everything around Bitcoin as the denominator. How can you financialize on top of Bitcoin? How can you, the whole DAT phenomenon, I would put in that bucket. The second one is around stablecoins and RWA, right? Stablecoins being the first, basically fiat being tokenized, especially dollar. That's the first use case. In future, there may be more financial assets that basically come on chain. And then the third one is basically trading and speculation. I think a lot of the alpha has gone into previous sort of centralized venues and market making, players in the area. The future trend will be around some of that going towards on-chain activities. And that's sort of a good trend to sort of underwrite and closely monitor. And then underneath all of these like 3 big themes, I would say, as more assets in each of these areas come on chain, you basically have that underlying DeFi layer that enables basically new financial primitives to be built and utilized basically with that growing sort of set of tokenized assets, right? Though here you have like leading players generating real revenues and cash flows, right? And so there you can already talk about sort of the new revenue meta. You can actually deploy fundamental analysis on some of that. You can put multiples on some KPIs you actually look. So this is getting into sort of more mature TradFi territories. And then a lot of the other things that are still sort of on the horizon, it's still primarily a VC game, I would say. Yeah. So that's what I would say is sort of the current sources of alpha, I would.
But and I think what you're saying is exactly playing out, actually. It's quite interesting to see the kind of mini altcoin season we've had over the last 3-6 months or so-ish. There's been a lot of dispersion. I mean, the tokens that have done well are actually very few. And actually many of the themes you described are among some of the tokens you find in those that have performed this year. If you look at where altcoins are this year, the vast majority are still under watermark or down on the year, and they're just a few that have shined, which have generally strong fundamentals, generating cash flows, and so on for most part. And this is interesting because this is creating, I think, alpha opportunities for people like yourself or for us, for anybody who's kind of actively managing tokens in a space which is professionalizing, so to say. If there's no dispersion, if it's just all one correlation trade and everything is going up like it was in 21, to be honest, there's not that much alpha you can generate on top of that. If you have to be more selective, then that's, I think, where you can differentiate yourself. So it's a good opportunity, to say.
Couldn't agree more, and that's why I guess the places that I try to operate is in the spaces where I see the greatest potential rate of change, and I actually think that DeFi is sort of one of these categories. And some might think of them as dinosaurs. They've been around for a while, but they generate cash, they have moats, and I think with potentially a lot of stablecoin growth, these things are set to generate more cash, and the moats get even stronger. And so I try to kind of look for these pockets where I expect the greatest rate of change in the community to be the strongest. And I think these coins have, this year at least, have sort of performed well on that basis. So,
yeah. So to Xiao-Xiao's point earlier about this necessity for professional liquid managers who know how to effectively manage market-neutral environments, we obviously had a pretty significant test about that over the weekend, coming off the back of that. Would love to hear a bit, Anatoly, if you could walk us through what were some of the lessons and insights that you had of that from somebody who does run a sophisticated market-neutral fund. How did that go versus what your potential expectations were for such a fat-tailed event like that?
Well, being in a seat of a multi-manager fund, you can see underlying portfolios, all 76 in our case, running risk and portfolio positions on a millisecond basis. And that would give you this kind of precise control over every single underlying portfolio. Now, the things you are looking at is style drift, right? Because many managers suddenly deviate from their desired or kind of predetermined course of what strategy they are supposed to run. Then there is a alpha decay in a traditional normal circumstances. What we saw on Friday was massive dislocations and auto liquidations when you have to rebalance your book. If one leg of the trade is gone, you have to spot it within the next few milliseconds and liquidate the second part of the trade so that the book remains market neutral. So that's an amazing test, right? Honestly, inside, we want to see these sort of tests when we test our pods, not these sort of dislocations when we test our pods. Because the logic is every single pod which comes on the platform gets a test allocation sub 1 million, and we run this for months until we have statistical confidence in these pods to scale them up to 50 million, the largest pod. But when they're in a testing stage, this is your ability to kind of monitor and have a deep dive in their trades. What happens on Friday really was like this large-scale test across all the entire portfolio. And naturally, some of the pods were taken out of the market because they hit their stop limits. Again, all of them were testing pods, which is great because kind of you have a perfect evidence not to scale them up, right? They're out of the game. Then the good thing was that those which were in the scale-up stage, absolute majority of them delivered positive returns, which reinforces your confidence in them. And of course, we're going to continue to scale them up. So ultimately, a portfolio like us has multiple elements, and the amount of information you are controlling is measured in over 100 million data points on a daily basis coming from the portfolio. And all these data points are being kind of put together for the risk management purposes, portfolio analytics, and portfolio optimization. So we came out of Friday with one of the best days in our trading recent history, which ultimately, A, it was positive day, and ability to validate multiple strategies on the platform.
Also, do you want to add anything?
Yeah, I could just add a few things. I mean, obviously, it was I mean, for anybody who's watching these markets, it's a amazing, amazing data point to observe. Very stressful one, but quite amazing. And the only thing I would add to what you've said, I mean, it all makes sense. The dispersion was pretty broad. I mean, and you can really see the benefit of diversifying your allocation to across type of strategies. You have strategies out there that you would expect that are rather mean reverting, that will tend to try and, meaning when something drops, buys, assuming it's gonna mean revert. Obviously, these things didn't do well and lost money. But actually, surprisingly, a lot of the trend following Statar, there are many strategies that did very well, and I would agree with you. From what we've seen, more were positive than negative. Obviously, a few were wiped out. In the case of the managers we allocate, none were wiped out, but some suffered liquidations and had to handle it. I think our result was similar, like more or less flattish. But I would still say, from my perspective, you asked us, were you satisfied? Are you happy with the outcome? I think there was one point which was dissatisfying in my sense. There are many of these. Typically, when you get liquidations in crypto markets, as a market neutral manager, as a hedge fund, you're usually on the winning side of this. In most cases, right? Liquidations are usually a source can generate a lot of alpha for managers, because typically retail is getting liquidated and you get on, and it dislocates prices, and you get to go and trade, through this dislocation, take advantage of it, because a price of one future is dislocated on one exchange and it's not on the other one. In this case, the dislocation was so massive and basically it was all market makers kind of pulling completely out of the market. The liquidities were completely dropped, and the exchanges were unresponsive. And so I think for many of these players that typically, would go and take advantage of these type of dislocations, liquidations in markets, they couldn't, because there was too little responsiveness. And I think, I went through a similar experience back in, I think it was in May of 2021. Lots of liquidations, very dislocated derivative instruments. But I mean, huge opportunities to step in and actually, as a hedge fund manager or any active trader, take the other side of this. And I think it was harder this time around because the exchanges were, and in particular Binance, were particularly dysfunctional.
Yeah. Anything you guys want to add in terms of the weekend lessons and insights?
Maybe I would just add on my side, we don't take leverage, and it's a kind of a reminder, why we don't do that, because we want to take long-term perspectives on the investments that we make. And one way to sort of blow yourself out of a position that you fundamentally think is good is by taking leverage and not being able to sustain the position in tough times. So anyways, it just kind of confirms that strategy on my behalf.
I think very short from my side, it's the difference between trading and investing, right? Like if you invest, you take longer term views on markets and teams and products, and whatever happened because of the tweet and because of leverage, it shouldn't matter about your investment thesis, right? In fact, it's actually strengthening why portfolios should probably not be fully allocated only to liquid, although I love liquid, and I think the sector needs more liquidity. But you need to have a good balance between, the gold standard commodity, which is Bitcoin. You need some decent private strategies to basically get exposure to long-term market growth. And then I think the role of market neutral is almost like fixed income, right? Like you don't want to park your cash in money market funds or banks. You want to have just stable sources of returns that is uncorrelated to the rest. And I think we'll leave it to sort of allocators to decide the allocation between the two. But fundamentally, I think there needs to be a healthy, percentage allocation between these three types of allocations ultimately.
It looks like this event was a non-event for you, Friday, right? It was very sleepless night for us. Very satisfying, but sleepless. but not for you.
It didn't feel good either. But again, you know, I wish I had more cash. Is kind of my feeling, and I kind of said, you know, in the green room that like the way I sort of kind of hedge our portfolio is just to create more cash at certain moments. And you know, I guess yeah, it was a day that there were a lot of good buying opportunities, and I had a shopping list, and I wish I had more cash.
Well said. So just thinking about the market structure evolving over the next few years, of course, multi-strats, pod shops in the TradFi world is the bread and butter these days, and now we're seeing, you know, more of it in the crypto world, such as your firm. I'm curious, Nicolas, you mentioned earlier this dynamic of dispersion increasing, where yeah, it used to be where there's either alt or on or off, everything's going up or everything's going down, and now we just see such wide dispersion. I'm curious how all of you are thinking about the evolution of the market structure over the next years as the industry matures, as we get, you know, more multi-strats into the space. What does that do for correlations and market structure overall?
I mean, I can talk a little bit. There are different angles to this. I'll start like kind of high level, some of the big flows. So I think one of the big changes that we've had is way more institutional flows, particularly into Bitcoin. So it obviously can be through ETFs. It's been through the treasuries. So you're seeing a much larger portion of the crypto market, which is, you know, VWAP, TWAP, kind of big orders going through, being placed by institutions rather than, you know, retail gambling, if you like, on the side. And so that proportion is changing a little bit, the dynamics. On top of that, you add all the call overriding that you're seeing, which I think has increased quite a lot. So, you know, treasuries, which are selling call to generate yields. They have the fact that you have options on ETFs now that make it way easier also for traditional players to kind of go and capture that premium. That is also part of, in my opinion, part of the reason why the volatility is coming down on Bitcoin, for example, right? Because you're selling a lot of vol into the market. The person who's on the other hand of that, the broker, if you like, is kind of long gamma. He's going to sell when price of Bitcoin goes up, and he's going to buy when the price of Bitcoin goes down. Obviously, a lot of that dynamic, and so I think that is kind of changing a little bit the dynamic of the market. Interestingly enough, it's, you know, obviously on the weekend, all those participants are gone. Yeah. So it's not much of a surprise that what happened on Friday after US close happened on Friday after US close. Probably wouldn't have happened this way during the week. So this is, I think, changing the dynamic of the market quite a bit. I mean, I'll let you talk a little bit about, you know, more the pods and maybe all those systematic teams and how they're kind of changing the micro side of the market. But I think that is a big change. Yeah. And right now, I think I don't know how this will evolve. Right now, clearly, I think the dominance of institutional flows versus those more retail frothy flows is changing, and that has implications on markets, how prices trade, on which strategies, which alpha strategies work well versus not. So a lot of transition, I would say, right now.
And naturally, you have all major hedge funds from traditional space are looking at crypto as a new frontier. And if you look on 13F disclosure, you would see Millennium with 2.5 billion, Schoenfeld with 1 billion. You have Citadel with 1.5. So basically, kind of every single major hedge fund see this as an expansion avenue. Now, at this stage, they're running relatively straightforward and easy strategies, such as basis trade, long ETF, short CME future. Would they go into start ARB, RV? The answer is yes. It's only a matter of time. At this stage, there might be some regulatory restrictions as to how deeply they can engage themselves with crypto, but it's coming. So that's going to impact the alpha in the space, and certainly they're going to be kind of alpha decay and compression. Interestingly enough, when you run a multi-manager hedge fund, you are observing how alpha is changing across multiple pots. And from our perspective, that's a critical element, because as some of the managers underperform because their alpha is decaying, you can dynamically reallocate capital to other managers, right? And that's the beauty of multi-strat. Now, another thing is overall kind of style drift, which is extremely critical. Some of the managers pitch you the certain idea, right, certain strategy, but once they start trading, under certain circumstances, they are deviating from their path. which actually is a red flag for you as a multi-strat hedge fund. And this is a point of conversation. For example, on Friday again, right, the dislocations were so massive and performance so kind of unusually, kind of crystallized in unusual manner that some of the managers were up 30% for the day, which is abnormal, right? Kind of, we wouldn't expect from a given strategy to deliver that sort of return, which from our perspective is something which we're going to sit down and discuss. Naturally, I'm going to take it, but fundamentally, this is a massive style drift, right? And you have to be careful how you control the whole risk spectrum and how alpha is migrating from one strategy to another.
Any insights on the venture side in terms of where that will evolve over the next few years, you think?
Yeah, look, I think it's a simple function of, like in the previous cycle, the total amount of tokens in the crypto markets were in the thousands and maybe tens of thousands, right? And now we're basically, since the whole emergence of memes and pump fun, this is like going completely bananas, right? Like we're dealing with millions, tens of millions, and you know, being hundreds of thousands being created every day. And so that glut of oversupply, essentially, of and accelerating that is basically the marginal cost of creating new tokens, right? Before you needed at least to write a white paper and have hire 5 to 10 blockchain developers, which were very expensive, right? To kind of launch a token. Nowadays, it's it costs nothing, right? Like you can get liquidity very quickly. Bonding curves are basically created ready for you on 10 different launch pads. And so that oversupply will not stop, right? Whereas the demand, also, although I agree, right? A lot of institutions are coming. Yes, they're coming, but we didn't have yet a huge sort of influx of new retail demand. And so just looking at that, I think necessarily the space has to go into more professional price discovery, right? Like we need new mechanisms to help everyone in a sector to differentiate what is real and what is, just attention economy, right? And although you will always have these pockets of attention economy network effects that will just drive, liquidity and demand to go in there, I think there are great initiatives like the Blockworks, token, transparency framework, and then, more and more, I think projects will develop also investor relation functions, actually basically creating data, right? Creating reports, creating relationships with professional investors, which didn't exist at all, right? In the last few years. And I think all of this is needed essentially to help, address this imbalance, right? Because that supply will not stop, and it will become easier and easier to launch new projects. And so, yeah, I'm all for focusing on fundamentals and revenues and having more professional liquid investors coming in and help everyone basically differentiate between.
Yeah, absolutely. All right, one minute left. Thomas, I'd love to just hear your concluding remarks in terms of where you see the alpha world heading into the next couple of years here as the market structure matures.
Yeah, I guess big picture, I would say, my thesis will be fundamentals will matter more increasingly over time. And sometimes it's a little hard to see that in a given moment, but I think the trend is actually quite clear and in that direction. And maybe it speaks to a little bit the dispersion of the different liquid coin performance that we've seen. And I think it actually tracks fairly nicely to what I would see as fundamentals, or at least activity. And I think that's good for people that are active, managers and studying things really deeply, as the four of us are. Yeah, and I would also say, I think about sort of what's the slope of enlightenment? You got sort of Bitcoin, furthest along. Behind that, I would say you have, layer ones. Behind that, and maybe right there is stable coins. Behind that, I think you have DeFi. And so I'm looking for these places that have sort of the most inflective opportunity in a given period of time, and just trying to kind of find those pockets.
Amazing. Well, that's all the time we have. Please give a round of applause for our panelists here. That was really great. Thank you, guys.
Thank you, guys.
Thank you.